Today I would like to analyze Beyond Meat. It's a company that makes plant-based meat alternatives. They have products like burgers, sausages, and chicken, which are made from plants such as peas, beans, and rice, but are designed to taste and feel like real meat. If we take a look at the stock price, we can see we are down 54% in 1 year, and the 5-year chart looks even worse, which is down 94%. So we have to take a look at the financials to find out if this company is actually undervalued. The first thing we can recognize is a market cap of 266 million US dollar. So this is when we take the current stock price, multiply with the stock outstanding. So this is still a small market cap, which can mean the company has a lot of room to grow in the future. What we like to see now is a strong revenue growth over the last 5 years. So we can see here in 2019, the revenue was around 297. And then we have an increase of 36%, then an increase of 14% in 2021, and then we have a decline around 10%, and then again a decline of 18% in 2023. So over 5 years, we have a revenue growth, but now we have a decline 2 years in a row, which is not looking great. So I would say it's not a check here because especially when we have the company that is still unprofitable, we would like to see the revenue growth in every year actually. So now 2 years we don't have a revenue growth. This is not looking great. Now we would like to see the net income to improve in the last 5 years. So the net income is the total profit after subtracting all of its costs, such as operating expenses, taxes, and interest. So this can show the profitability of this company. And we can see here in 2019, it was around 12 million in the negative. Then we have a even worse year in 2020 with 52 million in the negative. And then it's got even worse with 182 million in the negative. And in 2023, 366 million in the negative. And then we have a slight improve in 2023. So overall, it's not improved. So it's not a check here. Now we would like to see the free cash flow improve over the last 5 years. So the free cash flow is the money the company has left after paying for its regular business operation. So this money can be used to pay dividends, buy back stocks, or pay the debt. So this is a very important number. We can see here in 2019, it was around 70 million in the negative. It's got worse in 2020 with 97 million in the negative, and then even worse with 437 million. So then we have a slight improve over the last 2 years. So in 2020, it's improvement, and then also in 2023 with 118 million. So overall, it's not a check here. It didn't improve over the last 5 years. What I can say about the free cash flow is that it's looking not good. They're losing a lot of money every year since 5 years in a row. So we don't like to see that. We would like to see an improvement. So especially for a young company, it's normal to have a negative free cash flow because they need to invest in their business, maybe buy factories, and this costs a lot of money. But actually, we would like to see an improvement over the last 5 years. So it's not good to see that every year they have a bad free cash flow, and it's got even worse in some years. So we can see here, 2021, it was 437 million in the negative, which is very much. So if this keeps going like this, the company will have a hard time and maybe even facing bankruptcy. Now we're going to take a look at the balance sheet. We would like to see the cash on hand to be at least 10% of the market cap. This is very important, especially for young companies, because they need the cash to invest in the business and also to pay back the debt. So if they cannot pay back the debt, they will go bankrupt. So we don't like to see that. We can see here they have 122 million in 2024. So I'm gonna write it down here. And 10% of the market cap would be 26 million. So it's looking good about it. Actually, they have 122 million, is close to half of the market cap. This is a very good number. But we also have to consider the debt. So the debt should be 30% of the market cap. So what we're gonna see here, we have the short-term debt, it's around 5 million, and then we have the long-term debt, and we can see here it's around 1.22 billion. This is a lot actually. So the debt is around 1.2, let's say 27 billion. and 30% of the market cap would be, let me calculate it, would be 79 million. So this is looking very bad about the debt actually. They have over 1 billion debt. So I don't know how they can pay this back. They just have 122 million in the bank, and they have a lot of debt, and they have a negative free cash flow of 118 million. So this company is in a big trouble in my opinion. So it's not a check here, and I think it's very dangerous to invest in this company. I would like to give my conclusion about this company. So let's start with the positive things. So for me, the only positive about this company is the potential buyout opportunity. So maybe some bigger company like McDonald's could buy this company for a higher stock price. So this would increase the stock price a lot, I would say. But there's also a lot of negative things. So we have the revenue decline over the last 2 years. Then we have the negative free cash flow, which is not good because they have a lot of debt as well, over 1.27 billion. And when they have a negative free cash flow, they cannot pay back the debt. And this debt is a lot, so I don't really know how they're gonna pay this back. So for me, this company is a lot in danger for bankruptcy actually. I don't see how they can survive 2025. I think they have too much debt and negative free cash flow. The only opportunity would be the potential buyout, in my opinion. So investing in the stock is very risky.